All right, let's get right into it. We're doing a technical deep dive on the tax rules for shared driveway easements. Now, this is something that a lot of property owners deal with, but frankly, the financial side is almost always misunderstood, and that can lead to some really nasty tax surprises down the road. So we're going to break it all down, rule by rule.
So, here's how we're going to tackle this. First, we'll figure out what kind of transaction we're even looking at. Then we'll get into the nitty-gritty of the math, the compliance paperwork, and some major traps you need to avoid.
First things first. Before you can even think about calculating a single dime of tax, you have to figure out the fundamental legal character of the money you received. This one decision dictates absolutely everything that comes after it.
So let's picture it. Your neighbor gives you a check for the right to use part of your driveway. Is that a sale of a property right, which means potential capital gains? Or is it just rent, which gets taxed as ordinary income? The tax code doesn't care what you call it. It cares about the substance of the deal.
And believe me, this distinction is huge for your wallet. If it's a perpetual easement, the law sees it as a sale. That means you get to subtract your property's cost basis from the payment, and any profit left over is taxed at those lower capital gains rates. But if it's just a temporary deal, it's treated like a lease. The entire payment, every single dollar, is ordinary rental income under IRC Section 61, taxed at your highest personal rate with zero basis recovery. A massive difference.
So what's the magic word the IRS is looking for? Perpetuity. Does the right run with the land forever? IRS Revenue Ruling 68-291 makes it crystal clear if the rights you grant are permanent, it's a sale. And that's true even if you also get to keep using the driveway yourself. On the flip side, if your agreement has an end date or you can just revoke it, it's not a sale, it's rent. It's really that black and white.
Okay, so we've established it's a sale. Now for the fun part, the math. Let's walk through exactly how you calculate the gain, because this is a very precise process, and it all starts with your basis.
Now this is a big one. This is where a lot of people go wrong. Treasury Regulation 1.61-6A is incredibly strict on this point. You can't just take the payment and apply it against the cost basis of your entire property. No, you have to do what's called an equitable apportionment. You have to calculate the specific basis for just that little strip of land the easement covers.
And the IRS doesn't leave you guessing how to do this. They expect you to use this specific formula. You take the total basis of your property and you multiply it by a fraction. That fraction is the fair market value of the easement divided by the fair market value of your whole property. The answer you get is the only basis you can use to offset that payment.
Now you might hear about a famous old case, Inaja Land Co, which created a sort of loophole. The idea is, if it's truly impossible or impracticable to figure out which part of the property is affected, then you can apply the payment against the basis of the whole thing. But I have to give you a major warning here. The IRS, in that same Revenue Ruling 68-291, basically slammed the door on this for most situations. For a driveway with clear boundaries, you absolutely must allocate. So since you can usually only allocate a tiny amount of basis to a driveway strip, you're often looking at a taxable gain. So what's the best way to legally minimize that tax bill? Well, this is where a really powerful strategy comes into play. Severance damages. Think about it this way. Severance damages aren't for the land you sold. They're compensation for the harm done to the property you kept, your house, your yard, because of the new easement. Maybe it's more traffic, more noise, less privacy. And this is a brilliant move, because these payments can be offset against the basis of your entire remaining property, which is obviously a much larger number.
But, and this is a huge but, there's a catch. This is not something you can just decide to do later. It has to be in the contract from day one. The agreement must explicitly break out the payment, something like $5,000 for the easement grant and $25,000 for severance damages to the retained property. If it's just a single lump sum, the IRS will assume the entire amount was for the easement, and you lose out.
And you don't have to take my word for it. The IRS puts it in black and white in their own publication 544. No specific written allocation means no severance damage treatment. The burden of proof is entirely on you, and it all starts with what's written in that contract.
Okay, let's switch gears to the paperwork, because honestly, this is a non-negotiable compliance step that gets missed constantly in these private neighbor-to-neighbor deals.
So, what's the minimum payment amount that triggers an IRS reporting requirement for a shared driveway easement? $1,000? $500? Nope, it's zero. Any sale of an interest in land, no matter how small, has to be reported to the IRS on a Form 1099-S.
There is no minimum.
So in a simple deal, no lawyers, no closing agents, just you and your neighbor. Who is on the hook for filing this form? Is it you, the seller? Is it your neighbor, the buyer? Or can you just, forget about it?
Well, Treasury Regulation 1.605-4E lays out a very clear pecking order. Normally, it's the closing agent or attorney. But if there isn't one, the legal obligation falls squarely on the buyer, the transferee. That means your neighbor is legally required to get your Social Security number and report the payment they made to you directly to the IRS. All right, I need you to pay very close attention to this next part, because this is probably the most common and most costly mistake people make. It's the assumption that your home sale exclusion is going to protect you. Let me be perfectly clear. This is a massive trap. That incredible tax exclusion under Internal Revenue Code Section 121, the one that lets you exclude up to $500,000 in gain from selling your main home, is completely 100% unavailable for a standalone easement sale. And the reason why is spelled out right there in Treasury Regulation 1.121-4-E. The exclusion only works if the sale includes your actual house, or if it happens right around the same time you're selling your house. Since you're just selling rights to a piece of your land while you continue to live there, neither of those conditions is met. Bottom line, any gain is fully taxable capital gain, period.
Okay, for our last point, let's put all this in context. It's really helpful to see how a voluntary deal you make with a neighbor is different from, say, the government or a utility company forcing an easement on your land through condemnation.
The key difference here really comes down to one word: choice. A deal with your neighbor is voluntary. When the government forces a sale, it's called an involuntary conversion. And that unlocks a super powerful tax deferral rule under IRC Section 1033, which lets you avoid tax completely if you reinvest the proceeds in similar property. That entire tool is completely off the table for a private voluntary agreement.
So let's wrap this all up. First, characterize the deal correctly. Perpetual means sale, temporary means rent. Second, remember that Form 1099-S reporting is not optional. Third, do not fall into that Section 121 Principal Residence Trap. And finally, your most powerful strategy is a specific, written allocation to severance damages. Which really leaves us with one last question. Given all these complex rules, are you absolutely sure that simple handshake agreement you made with your neighbor is ready to stand up to IRS scrutiny?